crude awakening. Oil prices are rising as Secretary of State Mike Pompeo is announcing that the U.S. is ending sanction waivers for countries still buying oil from Iran. You can see the price of oil taking a big spike today, with crude up about 2.7%. Let's watch what Pompeo had to say.
Up to 40% of the regime's revenue comes from oil sales. It's the regime's number one source of cash. Before our sanctions went into effect, Iran would generate as much as $50 billion annually in oil revenue. Today, I'm announcing that we will no longer grant any exemptions. We're going to zero across the board.
Well, countries like China, India, South Korea, and Turkey will face economic penalties should they continue buying oil from Iran past May. Joining us now is Stephen Schork, founder and publisher of the Schork Report. And Stephen, the big question is, how will this impact the price of oil? What does this mean for the price of oil in, say, a month or 2 months from now? What do you think?
Well, it's an excellent question. I find the timing of this announcement rather curious. We are now coming out of the weakest demand season for oil, or the weakest part of the year for demand for oil. Once we transition into May, June, of course, here in the Northern Hemisphere, we'll start to see a significant rise in demand for crude oil. So this is a very curious time, and obviously it will have an upward lift on prices should we see any sort of material destruction to Iranian exports. Now, keep in mind, Iranian exports are already at a 5-year low. They're down to 1.2 million barrels a day. So theoretically, that's not a lot of oil, given the increased capacity we're seeing here in the United States and the excess capacity in Saudi Arabia. But that said, certainly there's a number of speculators in the market. And if we see any sort of untoward demand, this certainly is supportive of price looking ahead 1 month.
Stephen, I want to bring up a tweet from President Trump. Now, he tweeted in response to all this, saying that, quote, Saudi Arabia and others in OPEC will more than make up for the oil flow difference. You were talking about the fact that Iranian exports are at a 5-year low. Do you think that OPEC will be able to offset any of the supply disruption that we could see from Iran?
The only OPEC country capable right now of making up this excess supply would be Saudi Arabia. We looked at about 3 or 4 different estimates on production, and every country outside of Saudi Arabia is at peak production right now. Saudi Arabia is now at about 85% of its capacity. Their current exports relative to a year ago were at about 400,000 barrels below. That's 400,000 barrels a day below what they were able to do back in 2012. So theoretically, that's another 400,000 barrels that could be brought to the market. So that's of the 1.2 of the Iranian exports that would go missing. And I want to underscore, they're not going to go missing. But let's just play this theoretical game that they do go missing. Well, we've got 1/3 of that covered by Saudi Arabia alone. Also in the United States, crude oil production has grown 76% over the last 2 years. Exports have more than doubled. The United States put an extra 844,000 barrels of oil onto the market. U.S. production is expected to grow by 1.6 million barrels a day this summer. So in theory, perhaps the United States in Saudi Arabia could offset all of the Iranian exports that go missing. But again, I'll underscore, those exports are not going to go completely missing.
Stephen, how much do you think that the geopolitical risk premium is already priced into the price of oil as we're seeing it today?
Certainly, that's a big factor, because before Iran, we've had situations in Nigeria, of course, Venezuela, Libya was the big headline last week. So we already had a number of potential hits to the market. These are the known unknowns out there, that the oil that's already going to missing, or that could go missing. So we already have a significant geopolitical risk. I would venture, though, we're just on the cusp of that risk. That when we saw last September, actually, when the crude oil demand had already peaked and we were going into the doldrums of the fall demand season, oil rallied $10 a barrel in the month of September because the Iranian sanctions, the reinstatement of the sanctions, were going to go into effect on November 1st. Now, this is interesting because we had a bubble and oil spiked at a year-to-date high back in September of $75 a barrel here in New York. Now, in October, when these waivers on the sanctions were introduced, the price of oil crashed. So now we're at a situation that these waivers are no longer going to be extended, and we're on the cusp of the peak demand season. So I'll venture that the geopolitical risk is being priced in, but we can still have a considerable way to go higher at this point.
Stephen, what do you think this means for the earnings outlook in the energy sector so far? Obviously, this could impact some of the earnings over the next couple of quarters, not so much what we will be getting, but I would think that we would see it maybe play into some of the forecasts that we will be getting over the next couple of weeks.
Right. So it's interesting. So when we're looking at very high oil prices, so for an integrated oil company, this could be a good thing for the upstream side, the production side of your balance sheet. That, of course, higher oil prices certainly are conducive to your earnings. But also on the downstream side, on the refinery side, it could be a potential hit. So if you're a Valero, the largest refinery out there, you're getting squeezed because you have higher oil prices, but then you have the demand elasticities for gasoline to be kicked in, and you'll start to squeeze those margins. So for all-out crude oil producers, this would be supportive on earnings. But for the integrated and for the companies heavy on refinery and transportation, this could present a challenging time for them.
All right, Stephen Schork, thanks so much for joining us today.